All right, picking up from the last video, I want to talk about Germany's situation because Germany is a pretty good template for the European model. It's not a perfect template. Obviously, the systems and institutions vary from country to country, but if we had to pick one country to exemplify the European model, it would be Germany, just like we use the US to exemplify the Anglo model. So Germany has a Securities Trading Act that was passed back in 1994, and this was the first major insider trading law that actually prohibited trading on private information. Again, something that's long been illegal in the U.S. It wasn't until 1994 that we see an attempt to try to address it in Europe. This information is only relevant if it significantly affects the price of a stock. So it doesn't apply to all insider information. It only applies to that information that would significantly affect the price of the stock. Where in the US, it applies to all inside information, regardless of its impact. Minimal effects. There was no blackout period as a result of this act. The blackout period is the period in which insiders cannot trade. So there was not any blackout period, and there was no reporting on any remuneration for transactions less than 25,000 euro. So small denomination transactions would effectively be allowed with insider trading. European countries have generally less protection from insider trading than in the US, and this increases the risk to investors lacking inside information, especially smaller investors. We keep coming back to this idea of small investors kind of being disenfranchised with these policies in Europe, and that's going to be an issue because small investors, even though they're each putting in a small amount of money, en masse, they end up contributing a large amount of capital to corporations. So without incentivizing small investors to invest, you end up with less capital available for corporate expansion than would otherwise be the case. Okay, take a look at this table here, and we've got a variety of countries listed, but I want you to focus on the two that we're using to represent the different systems, the United States for the Anglo model and Germany for the European model. So controlling owner is the first column, and it shows the percent of firms that have a single controlling owner. So in the US, 4% of firms, publicly traded firms, have a single controlling owner, whereas in Germany, it's 57%. So the likelihood of having that consolidation of ownership in the hands of a smaller group of people or even one owner is greater in that European model than it would be, generally speaking, in the Anglo model. Then the next column shows widely held. This is the percent of firms that have broad ownership, a lot of owners. And you'll notice that in Germany, we're at 13%, whereas in the US, it's at 74%. So if you put these two together, you can say that in the US Anglo model, we end up with less controlling ownership and more widely held corporations, whereas in the European model, we get more controlling ownership and less widely held corporations. And then the severity of insider trading laws. This is ranked from 1 to 5, with 5 being the most strict laws and 1 being the least strict. So if you look at the German model, we're at a 3. Okay? And then in the US, we're at a 5. For the most part, you're going to find that in the Anglo model countries, we have more insider trading laws than in the European model countries. This is probably a result of the ownership. So in the Anglo model countries, you have this widely held ownership. Smaller investors matter. The investors are supplying a much smaller fraction of the capital that company is utilizing. And they're going to be more concerned about insider trading because it puts them at a disadvantage. They don't have that information that those insiders do. But in the European model, because you have this consolidation of power, right, more controlling ownership and less widely held corporations, that concern is not as big of an issue. The insiders are running the country. They own running the company. They own the company, and so they don't really have as much of a need for laws to prevent trading on inside information. Okay. Corporate transparency is another important thing to consider. This is the supply of regular, accurate, and readily accessible information concerning corporate operations and profit prospects. The amount of transparency in Europe is less than what you would find in the Anglo model. And this may be because it's perceived as unnecessary. Remember, in the European model, stakeholders are more integrated with ownership. And you have insiders, right? People that have that information already. And as a result, there's not this broad swath of owners that are disconnected from the company that need information. The stakeholders and the insiders already have it. European companies that do want to list on an American exchange find that they actually have to release a lot of information that they wouldn't have to in Europe. So that's kind of a given that there's more standards in the US for transparency. If you click on this link here, it'll take you to a site known as EDGAR. And this is the Securities and Exchange Commission's website where you can pull up company filings. So you could put in GM, General Motors, for example, and it'll give you the income statement, the balance sheet, the cash flow statement, and all other documents that have been posted for that corporation. And regular postings are required in the US, but not so much in some of these European countries where, again, the information kind of stays in-house. And unless you're a stakeholder or an insider, you may not have that information. So again, it's harder to get small investors that are disconnected from the company to want to invest in this environment. Hostile takeovers, this is called corporate raiding, much less likely in the European model, in part because of that cross-ownership we talked about before, where since there's companies that own companies, there's less supply of shares available to be bought up. Stakeholders hold stocks for reasons other than profits and may be less open to selling. Remember, the stakeholders are sometimes the employees that own shares, and they're vested in the company for reasons other than profit. They have a job in that company. It's a much longer term outlook. And so if there's somebody that comes along like a Warren Buffett and says, hey, I want to buy the company, I'm going to pay X amount of dollars for shares, and makes an offer, well, a lot of the employees will say, well, we don't care. We're not interested in selling. We hold the stock because it's part of our stake in the company. Replacing management during difficult times may not be a goal of shareholders. In the Anglo model, if there's difficult times, profits start to drop and there's a strong incentive to take over a company and replace the management. But in Europe, it may be just the opposite. The desire may be to maintain that management, to see through that period of challenge. Mergers and acquisitions. These are where companies come together, often to improve their profits or to stay afloat. Sometimes companies come together because they can't survive if they compete with each other. This merger and acquisition process accelerated significantly in the 80s and 90s. It's kind of known as the merger and acquisition boom period in the US, and then afterwards in Europe in 1999. A couple of reasons. As the US started to see more consolidation of companies, they had companies in Europe had to follow suit to be competitive. When companies come together, usually they get economies of scale. They end up having lower average costs and efficiencies that otherwise wouldn't be there. So it's hard for companies that are smaller to compete with that. So Europe had to catch up to the US in terms of these mergers and acquisitions. Also, globalization of financial markets has made it easier for mergers and acquisitions. Simply put, stocks are traded internationally, so one company can buy up another company with relative ease. Or, as we said before, a corporate raider can buy up companies with relative ease. Germany's Mittelstand model is a good example of the way European corporations often operate. It means the middle ground or middle way model. These are small to medium-sized businesses that are known for highly specialized, high quality, and cost-efficient production. BMW comes to mind when I think of this model. BMW is highly specialized and high quality. Now, BMW would be a large size business, but it's not as big as, say, General Motors or Ford, which are known for less specialized and maybe lower quality production relatively speaking. These companies that operate in this middle way are charging more for their products, so they're usually in a position to pay more for their workers. So we see efficiency wages being the norm. And this fits with the European style of capitalism, that stakeholder, managerial perspective that prioritizes the workers over the shareholders. Some of the most profitable companies in the world actually sell low quality products at a really low price. That may be in the best interest of the shareholders because, again, the volume that they sell, like a Walmart, is so large they're able to push profits to the bottom line in mass. But that may not be in the best interest of the workers. A Walmart cannot pay the kind of wages that these Middleston model companies would be able to because they can't charge the prices to justify those wages. But the priority for a Walmart is bottom line profits to the shareholders, not the stakeholders, not the employees. It's just the opposite in this Middleston model and the European corporate environment in general. Some of the companies you may have heard of here, there's many beyond this, but these companies are often the leaders in their particular field. So it does show that you can produce higher quality and people are willing to pay for it, even if that means that the companies are less profitable than otherwise. The European model seems to produce few garage companies. Garage companies are small companies that start presumably in a garage or a dorm or something like that and evolve into large corporations. Facebook is an example of this. Apple, Microsoft. You can go down the list. A lot of tech companies are garage companies. In the US, 12 of the 50 largest companies, none in Europe, did not exist prior to 1950s. So that tells you something. It tells you that the US is a more fertile environment for these upstarts that want to grow rapidly. So why do we not see this in Europe? Well, one explanation is some of these European companies want to stay family owned. There's more of that small business perspective. Even going back to the Middleston model, they may not want to be big. We always assume that businesses want to grow, but that may not be the case, especially if you have a family-owned business that's just looking to feed the family. Stricter regulation limiting growth. This is a big one. We're going to see later on there's more government intervention in the business environment in Europe, meaning that it might be harder for them to rapidly grow into giant companies. And third, undeveloped venture capital market. We talked about this. In order for these small garage companies to actually grow rapidly, they have to get the capital to do that, and there may not be capital available for those high-risk ventures. This means that innovation in Europe typically comes from established companies rather than new startups. Let's talk about capital markets in Europe. Stock markets are less common. Probably because of this emphasis in the European model on stakeholder over shareholder interests. Shareholders want profits. They want to be prioritized. And if stakeholders are put ahead of them, they're not going to invest as much. Also, lack of minority shareholder rights. With the controlling interests and the insider, lack of transparency and so forth, minority shareholders, those small denomination investors, don't feel like they're represented. So they're less likely to want to invest. Also, European countries tend to have less property right protections because of their higher ratio of civil to common law. Civil law is government-made law. It's subject to the administration in power at a given time. Property could be confiscated, for example. Businesses could be shut down. Taxes could be assessed on a company to a greater extent under civil law than under common law. That makes investors more weary of these European model countries. Bank lending and bond markets are more common. In essence, the European corporations are likely to get their funds for expansion not from investors, but from borrowing funds in banks or borrowing directly in these bond markets. Because of the role of banks, they have a lot more influence in the decision making of a business. If a company wants to expand, they need to impress the banks. And that means oftentimes the banks become a stakeholder. They may actually have ownership in the company itself. Cross ownership patterns, company A owns B, owns C. One of those companies could be a bank. And that bank could actually sit on the board making decisions for the overall company.